I'd like to welcome you to our inaugural event of the Levy Institute Capitol Hill series. My name is Pavlina Tcherneva, and I'm the president of the Levy Economics Institute. This initiative was born from our mission to bridge rigorous real-world economic analysis with the practical needs of policymakers. For decades, the Levy Institute has built a reputation for challenging economic orthodoxies through empirical research and a deep institutional analysis of how our economy and how our monetary system work. Our pioneering work on financial instability and stock flow consistent analysis has shaped research and policy conversations around the globe, and this foundation really allowed us to predict the 2008 financial collapse, to anticipate the macroeconomic effects of policy responses after 2008 and after the COVID-19 pandemic, and to examine contemporary issues, such as the impact of tariffs on the economy. Now, our mission focuses on financial stability, on policy effectiveness, on pursuing genuine full employment, and economic well-being for American families. Beyond research, through our graduate programs, we train the next generation of policy-minded economists, with our alumni serving right here on the Hill and at all levels of government. They also hold positions in top financial institutions and other private and public organizations. This series aims to inject new ideas, some of which straddle the political divide, into policy conversations and to provide members of Congress with robust analytical tools to inform your policy work. We begin with the Federal Reserve because current events demand it. The administration's intention to influence interest rates has raised crucial questions about Federal Reserve independence and policy effectiveness. And while pressures on the Fed from the executive branch are not new in American history, what we're hoping to do here is raise substantive questions of Fed accountability and its policy toolkit. As Chairman Powell recently stated, there is an institutional relationship between the Federal Reserve and every administration. But we are a creature of Congress. We are a creature of statute. The Fed is a systemically important institution that is facing significant headwinds, not just the pressure from the executive branch, but it is also facing a potential fallout from an AI bubble. And importantly, when it comes to its inflation mandate, it is facing sources of inflation that are coming from the supply side: tariffs, energy volatility, climate disruptions, geopolitical risks, and these are sources that the Fed cannot effectively manage. Now, we at the Levy Economics Institute have long maintained that the Fed's capacity to fine-tune the economy with interest rates is extremely limited. And we have been critical of its anti-inflationary framework, which relies on suppressing economic activity and suppressing employment growth. There are policy alternatives that can achieve true full employment and price stability, but they are not part of the mainstream conversation. Even though Chairman Powell himself has questioned the NAIRU's empirical validity, weakening labor markets remain an explicit policy objective for fighting inflation. So what is the role of the Federal Reserve today? As a creature of Congress, the Fed's accountability lies with you, the people's representatives, and not the executive branch. This is the foundation for democratic governance, and it's really important to emphasize that Congress retains ultimate authority to instruct, to direct, and even redefine the Federal Reserve's objectives. Our goal today is to start a conversation about the future of the Fed. We want to explore the parameters of independence, the nature of accountability. We want to talk about the effectiveness of its policy tools in the hope that we can foster a productive conversation that will facilitate congressional oversight and collaboration that serve the public interest. I want to express special thanks to Representative Talib's office for co-sponsoring this series, and specifically to Will Flagel for the logistical support. I'm especially grateful to be joined today by leading experts on these topics from the Levy Institute and beyond. So the run of show for today is going to be as follows. We have with us Claudia Sahm, a chief economist at the New Century Advisors, who will kick off the discussion on why Fed independence matters. Please refer to the program for the complete bios. Afterwards, we will hear from Jamie Galbraith, who is a senior scholar at the Levy Economics Institute and who wrote the language governing the form and the content of the monetary policy hearings under the Humphrey-Hawkins Act. We then will hear from senior scholar Randy Wray, who is our expert on money, financial instability, and macroeconomic policy. And we'll conclude with remarks from Bill Bergman, who spent 14 years at the Federal Reserve Bank of Chicago. One of his roles was a senior financial market analyst. After brief remarks, we're going to have Q&A, and that will be moderated by Claire Jones, who is a U.S. economics editor at the Financial Times. So thank you very much for joining this important dialogue. And now I turn the floor to Claudia Sahm. Over this cord.
Okay. Great. Thank you so much. I'm really pleased to be here today, and I appreciate all of you taking time for what, I mean, it really is an important conversation. Unfortunately, it's more important today than it's been for many years, right, thinking about Fed independence. So I worked for a little over a decade at the Fed. I started in 2007, worked on the staff's macroeconomic forecast as the world was falling apart. And towards the end of my time, I was in the Division of Consumer and Community Affairs at the board. I have often been critical at different times of the Fed. I think it's an institution that welcomes criticism, and we can certainly, there are many ways that it could be better, but in a moment where the Fed is under threat and attack, I think it is useful to kind of step back and understand why is Fed independence? Why does this matter? And so I want to be very clear, Fed independence is a means to an end. Right? It is not about empowering a small group of unelected officials to make big decisions about interest rates. I mean, in reality, they are given a lot of discretion and power, and their decisions do really matter, but that's not why we do it, right? It is a means to an end. The end, very specifically, and as defined by Congress, is to keep relative stability in the economy. When we think about maximum employment, price stability, what that means is the Fed, its goal is to kind of smooth out, the ups and downs in the economy, avoid or soften the blow of a recession, avoid or soften the blow of a spike in inflation. Now, its tools are not perfect, and is certainly not the only game in town, nor should it ever be considered that. But I mean, that's the reason that we have Fed independence, is because that is considered, both from the experience in the United States and around the world, as the most effective, though still imperfect, means toward that end, right? And so just to be specific as to what I think of as what does Fed independence actually mean? It's very important if you do anything on the Fed, like drill down in all the terms, the euphemisms, the concepts, like what are we actually talking about? And specifically what I think of there as who makes the decision? Who controls what these interest rates are? I mean, these are policy interest rates, but typically the short-term interest rates. Is it a group of technocrats, so experts in the field, people using data and models, or is it a group of politicians, say a president, that is in charge of making the decision? And what we have seen is that over time, the draw of, say, an election cycle, And a year out from the midterms, we are in prime time for like central bank tampering, right? Like this is a moment where we should be very focused on who's making the decisions about interest rates, because it has historically been the case, US, around the world, politicians exert too much control. There's a temptation to really push interest rates down rapidly, dramatically, to try to kind of get a burst of activity in the economy. And the unfortunate side effect of that often ends up being inflation comes back, or you have some kind of financial instability, right? And this, again, it's not about this administration or about this moment in time. This is just something of, and there's a lot of research, I'm not, putting up slides today on all that, but it has turned out that the way to avoid the political cycle in interest rates is to give that responsibility, the day-to-day operational independence, to a group of technocrats, experts in the field. Now, that absolutely has to be paired with oversight and accountability, and Congress plays a very fundamental role in making sure that this works, and from time to time goes in and changes the tools that the Fed has at its disposal, changes what the goals are, redefining the mandate. But once those parameters are set, it is a group of individuals who are not politicians are making those decisions. So again, not a perfect solution, but it's what we have as our best bet of getting those end goals. Now, what does that mean today? Like how do we serve, particularly, how does Congress kind of further that goal at a moment where the Fed is under attack? We have a White House, the president speaking again today about where he thinks interest rates should be, getting ready to put a Fed chair in a position to, kind of lead the committee. It is incredibly important that the vetting of any candidates for the Federal Reserve is really thorough. And it's not just this rubber stamp of, do you believe in Fed independence? Why, yes, I do. But really dig into, well, how do you make determinations about interest rates? How do you think about the models? Maybe you come in thinking interest rates should be lower right now, but what would change your mind? And it ought to be something that ties to the data, some model, some theory, as opposed to, well, the president changes his mind, right? And so really pushing on that oversight to kind of get at do you have the tools, the expertise to, follow through and let reality guide policy as opposed to what the president wants. And then, of course, oversight goes well beyond nomination hearings, and Congress has, bringing the Fed chair in at least twice a year to kind of talk about, why did you make these decisions? What were the outcomes? And it is possible, we've had at least one of the front runners for Fed chair say, well, the Fed talks too much. Right, this is a Fed that has gone to a place where there's a lot of communication. After the meetings, they have press conferences, there's lots of out there speaking. And, if the Fed, starting next year, kind of turns itself inward and really shuts off some of that, that transparency, that it absolutely would be a moment for Congress to really turn up, kind of shine the light on the institution, because that transparency will be incredibly important going forward. So as I said, that was just kind of like how I think about this, why it's important on a very pragmatic level. What does it mean to make sure that this is a Fed that continues to be guided by the data, the models, the theory, and of course we can disagree on the tools that the Fed is used, how they're thinking through things, but that's the conversation that should be had, as opposed to just, the White House determining we're going to have ultra low interest rates, right? That could be a very unfortunate outcome.
Thanks. Okay. Next we go to Jamie Galbraith. Please be careful.
Can I put this down? Thank you very much. I first joined the congressional staff in the summer of 1974, the International Economic Subcommittee of the Joint Economic Committee, and returned in the early summer of 1975 to the House Banking Committee, of which Henry Royce had become chair, and shortly after Congress had passed House Concurrent Resolution 133, which obliged the chair of the Federal Reserve for the first time to appear on a regular schedule before the Banking Committees and to report on the conduct of monetary policy. In 1976, I was in the group which included Leon Kaiserling, first chair of the Council of Economic Advisors under President Truman, that met with Representative Augustus F. Hawkins to draft H.R. 50, the Hawkins-Royce predecessor to the Humphrey-Hawkins Act. No one else was much interested in monetary policy, so I drafted Section 108 of that bill, and love the law, basically in line with the reporting requirements already in place. The effect was to place the Federal Reserve unambiguously under what is now called the dual mandate, as it later became known, but specifically under the goal of full employment, something that had not been the case before. Over time, the Humphrey-Hawkins hearings have worked to transform the Federal Reserve into a public-facing institution. We began this process in June 1975, in the first of these hearings, by asking a very reluctant, secretive, and imperious Arthur Burns to provide the Fed's staff economic forecast, a totally innocuous request, which he declined to meet, but successive members of Congress continued to ask that question until the early afternoon. He finally tired and provided what he called his personal view. And the next question, of course, was, Mr. Chairman, is your personal view consistent or inconsistent with the view of the Federal Reserve staff? And at that point, the cat was out of the bag and it never went back in. In 1978, the Humphrey-Hawkins Act became law. And in the summer of 1979, Paul Volcker took over at the Federal Reserve. There followed his supposed conversion to monetarism and a very glaring conflict between the full employment mandate and actual policy, which crushed manufacturing and drove unemployment past 10%, with interest rates that breached 20% for months. Yet Volcker also accelerated the transition toward openness. The hearings became a stage set largely by Chairman Royce, who would send a detailed interrogatory letter well in advance, about 6 weeks in advance of the hearings, prompting careful preparation by Fed staff of their chair in anticipation of questions that he knew we'd receive. I drafted those letters and retained copies of the hearing records. The details of the colloquies are not all that important in the long run, but they established the right of Congress to ask specific and detailed questions and to expect a well-prepared answer. And Chairman Volcker, very much to his credit, cooperated with this process. The policy conflict was nevertheless intense. And this brings me to the second point I want to make, which this conflict came to a head in the catastrophic recession of 1981-82, the immediate cause of the beginning of major deindustrialization of the United States, which is the long-term cause of the rise of China and, frankly, also of Donald Trump. By that time, I was at the Joint Economic Committee as executive director. From there, we attempted to test the power of Congress to pressure the Federal Reserve directly on interest rates. Recognizing that there was no single best way to do this, in fact, no truly good way to phrase a resolution, I drafted competing versions, one of them for Jim Wright, Majority Leader in the House, and the other one for Robert Byrd, Minority Leader in the Senate. One calling for lower long-term interest rates, and the other for lower real interest rates, whatever that might mean. The stratagem was intended and succeeded in creating a degree of confusion, which eventually brought the staff liaison of the Federal Reserve, Don Wynn, to my office. I don't think he was aware that I was behind all of this. He asking me what might bring take off the pressure. And I said, well, Don, if the interest rates start to fall, the air will probably go out of these balloons. And shortly afterwards, that's what happened. There was also a third resolution, which I had passed off to staff for Daniel Patrick Moynihan on the Budget Committee, calling for lower interest rates in response to budget restraint, which budget resolutions always pretend to have affected. I'd almost forgotten that one until a writer for the St. Louis Fed Journal resurrected it quite recently and gave it credit for having caused a certain amount of worry at the Federal Open Market Committee, as the minutes of May 18th, 1982 confirmed that, in fact, it did. Congress, in short, does have the power to effectively pressure the Federal Reserve on interest rate policy in conditions where it feels it's appropriate to do so. Of course, all this was long ago, and almost all the direct participants have long passed away. It's an advantage to be one of the last survivors. And I drifted from direct engagement after the mid-1980s, but let me offer a few remarks on what seems to have happened in the intervening 40 years. In the Greenspan era, the Fed mastered the art of using the oversight process for its own purposes. The stage direction passed from the bench to the witness table, and as effectively, so effectively that when legislation lapsed, the Fed carried on with the hearings on its own initiative until the mandate was restored. At the same time, Greenspan was markedly free of academic orthodoxy, allowing interest rates and unemployment to fall, achieving the Humphrey Hawkins goals for the first time in the late 1990s. The means, however, involved sequential speculative booms, which ended in grief in 2000 and 2008, a pattern that is now well established. Ben Bernanke brought the ideas of a rather dreary period in academic macroeconomics to the job, a kind of monetarism without monetary control, centered on an inflation target justified initially by a nonsense construct called the NERU, to be achieved by pronunciamiento and prestidigitation. Monetary policy as macro magic or as an act of faith. And I'm afraid Janet Yellen, I think, basically followed in the same tradition. But the economy evolved in such a way that the interest rate lost its capacity, its traction, which it had under Volcker, and no longer carried the kind of weight on macroeconomic variables that the models presumed it would have. As Wray and Nersessian have pointed out, and I'll let Randy deal with this in more detail, the 2% target has no legal basis, no basis in economic analysis, and the Fed has no actual capacity to hit it, habitually falling below or running above. By nodding along with this notion, Congress has abandoned its basic responsibility, and by turning the inflation problem over to the Fed, previous administration basically sealed its own fate, bringing the present one to power. I do have considerable sympathy for Chairman Powell, who as a banker has no higher scientific pretensions, makes arguments opportunistically, and conducts policy in the press. As I have written, that policy follows the long-standing pattern. The Fed conducts monetary policy to pressure and discipline the American workforce. What was hidden in secrecy, a central bank that's essentially acting as the agent of bankers, and later in economic obscurantism, is now openly admitted. And the question is, what to do about it? Of course, an openly political and distributive central bank invites political criticism, and in my view, one cannot fault this administration, or parts of it, from stating their view. But there is an obvious institutional difficulty, in which to cede, or to appear to cede to the White House, would compromise the integrity of the central bank, and behind it, the authority of the Congress. So it puts the Federal Reserve in an extremely difficult position to have pressure coming from the administration, even if it were to agree privately that the pressure had some merit. It would have to be very cautious about following along without appearing to becoming the tool of the White House. And what does that leave? That leaves the United States Congress to do the actual job entrusted to it by the Constitution and embodied in the law that's been in effect now for half a century, but which gives tools which are frankly not being effectively deployed, but which could be deployed if the Congress were to choose, first of all, to work out for itself what it wanted to achieve with the oversight of monetary policy, and secondly, to entrust to its own appropriate officials, to its chairs and members, the responsibility to bring the Federal Reserve back under the laws as a creature of Congress it should be. Thank you very much.
Thank you. Thank you, Jamie. Okay, Randy Wray, and you have a PowerPoint presentation?
Okay, as Pavlina mentioned, we've been doing this at Levy for quite a while. The first time we claimed that the Fed was flying blind was back in 1994. And so there are a series of pieces that go through our argument. I have listed 3 relatively recent ones, including 2 that were co-authored by Yeva, who Jamie already introduced. Depending on how you read Jamie's Humphrey Hawkins Act, the Fed has either a triple or quadruple mandate, but only one goal and one tool to achieve that. The Fed's interpretation since the time of Greenspan has been, well, magically, if you pursue low inflation, you get all of the other ones along with it. And as Powell told Congress recently, and Jamie mentioned this, central banks around the world have just decided inflation's magic number is 2%. The new monetary consensus, which I didn't take seriously when it was first proposed, but it has become the way that all central bankers in the world perceive inflation, is that it is caused by expectations of inflation. So inflation expectations cause inflation. The Fed must control inflation expectations to control inflation. People must believe the Fed can control inflation for the Fed to be able to control inflation expectations to control inflation. Okay? How? The Fed manipulates the short-term interest rate. Now I know there are 3 short-term interest rates for the corridor system to influence expectations to achieve its inflation target. The Fed is focusing on triple unobservables: inflation expectations, the real interest rate, and the natural rate of unemployment. None of these can be observed. The Fed itself has dissension within its ranks. Fed Governor Tarullo said inflation expectations are bearing an awful lot of weight in monetary policy these days, considering the range and depth of unanswered questions about them. Well, unless inflation expectations can save the day. The Fed's Jeremy Rudd wrote a very nice paper everyone should read. Nobody thinks clearly, no matter what they pretend. That's why people hang on so tight to their beliefs and opinions, because compared to the haphazard way they're arrived at, even the goofiest opinion seems wonderfully clear, sane, and self-evident. The Fed, Jamie referred to this, has been mismanaging the economy. It's been biased against growth and the labor market, at least since the Volcker era. The Fed raises rates whenever labor market favors workers, and it's relied on a flawed unemployment-inflation trade-off, briefly relieved, admittedly, during some of the Greenspan years, to raise interest rates in spite of inflation. So I do have a little bit of data to present. when does the Fed raise interest rates? It's very clear. It raises interest rates when, just a second, I'll tell you when it raises it. But it's very clear it is not raising them to fight inflation. Inflation came down after the Volcker era, and it's remained low for 40 years of low inflation, the blue line. The Fed's target rate is the red line. The Fed has been extremely active since 1980, fighting what? Not inflation. It's very clear they are not raising interest rates because of inflation. Why are they raising them? They raise them whenever the unemployment rate bottoms out. So in other words, they're fighting employment. That is the best predictor of when the Fed is going to raise rates. Expectations supposedly cause inflation. So here we have the actual inflation, the blue line, two measures of inflation expectations. You can see nothing going on with inflation expectations for 20 years. For 12 years. And when COVID hit, we do get some inflation. It was not preceded by inflation expectations. In fact, inflation expectations remained, in Fed speak, well grounded. Okay, so what determines inflation expectations? Well, they converge to reality. Inflation was very low, and so expectations were low. Gradually, they rose during the COVID inflationary period. Okay, so the response to the story I'm telling is, well, it seemed to work very well for a very long period of time. The Fed kept inflation at bay, right? The Fed was glad to take the credit for the low inflation since the 80s. I won't go through what Volcker did. Jamie already mentioned it. The reality was that inflation was tamed by globalized supply chains with cheap labor, low costs of regulations, and taxes abroad. In the domestic sector, we moved to just-in-time production, low or no inventories, reducing costs, jobless recoveries, depressing wages, and those factors that tamed inflation came back to bite with COVID as the supply chains collapsed. What's the typical source of inflation? At least in the United States, the mainstream view is inflation is a demand-side problem. Slow growth, which we had periodically, is a supply-side problem. Before COVID, we had secular stagnation due to supply-side problems. After COVID, excessive relief caused demand-side problems, and that's why we got inflation. What's the reality? In the US, inflation has always been a supply-side problem. We have chronically insufficient demand and depressed investment. We came to rely on globalized supply chains, as I already said. Supplies collapsed during COVID, gave us the deepest recession since the Great Depression. Trillions of dollars of fiscal spending led to the fastest recovery ever, but as Yeva and I warned early on, the spending was not well targeted, and it was not surprising that with the severe supply constraints, we got some inflation. So this time was different. COVID-induced supply-side problems. With that, patience was the best policy, and Powell initially agreed with that. Economists, I won't mention Larry Summers. I had a nice quote here, but we won't talk about him now. Economists pushed the Fed to act, but raising rates wasn't helpful. Consumers usually don't borrow to finance fuel, food, and rent, which are our main sources of inflation always. It hurts the supply of housing, especially rental unit construction, and of course we have a nationwide housing shortage. And then we have a cost feed-through effect. Interest is a cost of doing business. And we have interest income. The government is spending about $1 trillion in interest. That could possibly add to price pressures. The answer to supply-side inflation is not to reduce demand, but to increase supply. Building back better was a good idea. I'm going to have to skip this. Inflation is sectoral in the United States. It is always oil, food, and shelter. And most of shelter is imputed. It's not actually a cost that's paid by consumers. So, getting to the conclusion, what should the Congress do? The Fed is a creature of Congress, independent of the executive branch. As Fed officials proclaim, the Fed is not independent from government. It is independent within government. Chairman Bernanke, when he was being grilled in Congress in 2012, said, look, Congress created the Fed. Congress gave us our mandate. If you determine that you want to change it, we will, of course, do whatever you assign us to do. Our policy recommendations, we should target the Fed funds rate and keep it between 1% and 2%. Allow a little bit of flexibility in there, between 1% and 2%. Encourage investment, residential and other ways. Prioritize financial stability. That's what the Fed was created to do. Reduce market volatility by stabilizing rather than manipulating the rates. Strengthen the oversight of banks. Act as a lender of last resort with appropriate safeguards, not the way that we did it in the response to the global financial crisis. Conclusion, yes, the Fed should be independent of presidential meddling, but it's not independent of Congress. Rein in the Fed and free it from economist groupthink. It's time to revisit the Humphrey-Hawkins Act. It was formulated in the monetarist era when policy was supposed to control the money supply, to control prices. No one believes that anymore. Refocus the Fed on achievable goals, stability, regulation, and maintaining the payment system. That's what central banks ought to be focused on. Thank you.
Thank you, Randy. And now we have Bill Bergman.
Thanks. Cool. Thank you. Thanks to the Levy Institute. Thanks for coming. My name's Bill Bergman. I first got interested in this issue in a deeper way in 2001. I was sniffing at the new Bush administration and its views on executive branch authority, and worked on a paper and developed a paper titled National Emergency Powers and Federal Reserve Independence. I was concerned about aggressive executive branch authority going over the Fed. I got some great feedback from a serious constitutional law scholar in late August 2001, and ended up presenting that paper at the Library of Congress in November 2001. This relates in part to some of the things that we've been talking about. Is the Fed a creature of Congress? Certainly, the Fed is a creature of Congress. But the Fed also is a creature of the president. The Federal Reserve Act was passed by Congress, but signed by a president. And the Federal Reserve also has to report to a president who should take care that the laws be faithfully executed. That's something in the Constitution as well. So it's not just Congress is in charge of the whole program. Want me to speak up? Is that okay, cool. Yes. I can do that. All right, well, anyway, that's a good introduction. And I can't resist, and I have too much stuff anyway, but I brought two party favors to get things started. The first one is a book from 1952 by Blair Bullis, How to Get Rich in Washington is the book. This was a wonderful book in the muckraking tradition, digging into the abuse, and in fact, the Fed is an independent regulatory agency. That's the technical term for the Board of Governors. Its independent regulatory agency status can be threatened by something called capture theory. Regulators can be captured by the people they regulate. And that's another threat to Federal Reserve independence that's worth thinking about, I think importantly, historically and today. The other reason I can't resist bringing this one up is the price of this puppy in 1952 was 25 cents. The other one is a book by a hero, Paul Douglas, Economy in the National Government, another 1952 book. Douglas was a leader on the Federal Reserve independence area, including his leadership leading to the Accord in 1951. This book came out in 1952. The last chapter is titled, The Budget Must Be Balanced. And here we are today with greater interest in the interrelationship between fiscal policy and monetary policy in ways that we'll be getting into here shortly. My basic question is, I'm going to ask three questions, underlying them. When does Fed independence, in quotes, become tyranny? framed in three, looking backwards, looking at today, looking at our possible future. I like this flying while blind idea. I think that's very relevant, but we have to try to look ahead. How well has the Fed exercised its independence in the past? What's the major threat today to Federal Reserve independence? Looking ahead, is it basically toast? In regards to the tyranny idea, some background, we established a republic back in 1776 and 1787. The theory of republic is based on the rule of law. The rule of law is a check against tyranny. Unfortunately, sadly, I'm afraid, the rule of law can actually become a source of tyranny, a tool of tyranny. And I'm a fan of a fellow named Frederick Bastiat. I wrote a book called The Law back in the mid-1800s. What happens when law becomes a tool of plunder? And, well, here we're going to ask the question then, has Fed independence kind of been turned into a source of tyranny? What is it? As been noted, the Fed's a creature of Congress, but federal laws are also created when the president signs the law. and at the end of the day, the Fed is not only a creature of Congress, in my opinion. The Constitution directs the Fed, directs the president to take care that the laws be faithfully executed. Congress and the president created the Fed, and Congress and the president tomorrow could get a law passed to eliminate the Fed. And some people think that's the right direction to go. Okay, the Fed's dual mandate. I've got dual in quotes because there's three things as we've been, that's actually an important point. We've got three things. One of them is moderate long-term interest rates. What does that mean? How do you define moderate? Well, among other things, one of the reasons they stopped talking about the triple mandate is that we can't, what does moderate mean? We can't. Well, what is that? How about maximum employment? How do you operationalize that? How do you define it? How do you measure it? What are prices if they're stable? What does that mean? No price changes forever? Or where do you draw the line? How do you define this stuff? I'm a big fan of measurement issues with regards to money as well as inflation. How do you measure money? How do you measure inflation? It's so hard. It's really interesting stuff. At the end of the day, money is hard to measure. That doesn't mean it's unimportant. So let's step back from the economic mumbo-jumbo and just look at a simple question. The Federal Reserve was first directed to pursue stable prices in the Federal Reserve Reform Act of 1977. And the average Joe or Jane on the street, okay, how stable have prices been since 1977? There's a chart from Fred showing you the CPI since World War II. That dark line in the middle is 1977. Have prices been stable since 1977? The Fred chart has a long width and a short height. This is what it looks like on a cell phone. Have prices been stable since 1977? See that little puppy up there at the right too, the latest? Affordability, it's interesting that people talk about it in terms of, it should be an inflation idea too. Here's the CPI since the Federal Reserve decided that its mandate was 2%, out of thin air. And you can see the acceleration recently. More fundamentally, here's the average Joe or Jane knows about this stuff. There's a Big Mac was 65 cents back in 77, and a cup of coffee was 15 cents. Okay, today, what's going on and what is with independence? It's certainly a hot topic lately. Arguably, it's a convenient issue for some folks that are concerned about the new president. And President Trump has certainly made it easier to make it an issue. But I argue that he's not the major threat today. The major threat is a two-pronged threat. An important source, historically, of Fed independence is flatlined, and this umbilical cord that the Fed has with the Treasury is under growing stress. The two things we're going to talk about, people know about the elements of Fed independence, but the bottom two ideas, we're going to look at the budgetary independence of the Fed and the Federal Reserve Board as a, quote, independent regulatory agency. On budgetary independence, we've got the financial condition of the Federal Reserve banks and the financial condition of the federal government to think about. Arguably a source of issues relating to the independent exercise of monetary policy. Historically, the Fed's been, quote, self-funded. Arguably, it's still self-funded today. It has revenues and it pays people money. On the other hand, Federal Reserve earnings have disappeared. Anybody know what's happened in recent years? You guys must. I'm here in D.C., right? Speak to me. Yeah, we'll get to that interest on reserves idea here shortly. But yeah, the Fed is losing on an annualized basis $100 billion a year that it didn't used to do. How is it doing it? Well, it targets interest on reserves, and it pays interest to the banks. So what do these losses do? Normally, a company has losses, it hits the capital, right? Not at the Fed. Here are the four main sources of accounting standard setters in the United States. You've got FASB for the private sector, GASB for the state and local governments, FASAB for the Federal Accounting Standards Advisory Board, and the trick question is, who's the fourth? It's the Fed. The Fed sets its own accounting standards as an independent regulatory agency and changes them whenever it wants to in convenient ways. They've turned these losses into a dubious asset. There's debits and credits in accounting, and we end up with a deferred asset now called remittances to Treasury, which is still growing, north of $200 billion now. Those are the recognized losses on an operating basis. The big chunk of change is in the unrecognized losses in the portfolio of bonds that the Fed has. And if the Fed has to sell securities, well, you're going to see some interesting things happen to this account. Will the Fed losses be transitory? That's what they say. But that's what they said about inflation a few years ago. Key factor why the Fed is losing money is interest on reserves. It began paying this interest on reserves to banks for the first time during the financial crisis in 2008. One argument that they made was that this is going to reduce the risk to the Federal Reserve banks. They were so concerned that these banks might overdraw their accounts and fail and then have a loss transferred to the Fed, so we need an ample reserves regime. And we're going to pay banks interest in order to have them incentivized to have reserves at the Fed. Ironically, the Fed is now paying banks interest for the privilege of reducing the risk to the Fed. There's the reserves historically, next to nothing at $40 billion is nothing. And then you see the massive growth since the financial crisis. Here's a close-up on 2008. You can see they started growing in September during the Lehman and AIG failures. And the Fed started its quantitative easing process then. Here's something people don't know about too much, and that's the fact that the banks were overdrawing their accounts at the Fed significantly and in a wild pattern in the financial crisis until the ample reserves period was underway. And this posed risk to the Federal Reserve banks. Why does this matter for Fed accounting? Well, in the late 1990s, members of the Board of Governors were testifying to Congress in support of their position for the Fed to be at the top of the regulatory apparatus under Graham Leach Bliley for financial holding companies, that we need to be at the top because we're so concerned about the subsidy that banks have in the safety net, including FedWire in their definition of the safety net, because banks were overdrawing their accounts and the Fed guaranteed all the payments and exposing the Fed to risk. We need to be at the top to be able to scrutinize this stuff. Trouble is, every year since 1980, under the Monetary Control Act, the Fed has fully recovered the costs of providing its payment services to banks, it says, under its accounting statements, because the Monetary Control Act directed the Fed to not subsidize banks on FedWire. And in the late 1990s, I noticed these incongruous assertions from the Fed. And I wrote a paper. I was invited to present it here in Washington by a significant person, and that was the beginning of the end for me at the Fed. I shared it with a very good professor at the University of Chicago, and Bill, you're just talking out of both sides of your mouth, and that's what the Fed was doing. Well, Fed losses, does this threaten budgetary independence? Yes or no? And it's debatable. However, these large Fed losses we're no longer sending money back to the Treasury at the Fed these days. And because we aren't, we don't have this budgetary independence we have to. In addition, it's amplifying the federal government's own financial mess that Paul Douglas warned us against. So let's take a brief look, and I'll try to hustle, at the financial condition of the U.S. government. Now you see something that no one in America sees, but they should look at, and that's the financial report of the U.S. government. Here's something else no one sees. That's the balance sheet. Assets minus liabilities gives you net position. That asset at the top is worth talking about, but I'm not. That's student loans. That's the biggest asset now on the federal government's balance sheet. But basically, 6 trillion minus 46 trillion gives you a large negative number. One liability that isn't on the liabilities, or two actually, Medicare and Social Security. The federal government argues that they're not liabilities in accounting because the government controls the law and can change the law at any time. Trouble is that's also true for student loans, and with student loan for anyway, a longer. It's not a pretty picture, and it's getting worse. A balance sheet has three things, and so do all financial statements. They have words, they have numbers, and there's one more thing, a symbol. Those are all denominated in dollars. What's a dollar? A long story, a legal history. One scholar I respect argues that the government has deliberately turned it into a political abstraction, a malleable thing, on purpose, so the government can inflate away its debts. Introducing the balance sheet, here's the following language that helps comfort us. There are, however, other government resources available. These resources include the stewardship PP&E in addition to, and here's the key language, the government's possessive S, sovereign powers to tax and set monetary policy. Our government's going to be okay because it can take our money away, or it can inflate the value of the dollar away to pay off its debts. I'm not comforted, and mainly because of that possessive S. Who is sovereign in the United States of America? We the people. This is in a document theoretically securing the accountability of the government to the real sovereign of the United States. Not only that, this is a document from the Treasury saying that the government has the power to set monetary policy. Is that independence for the Fed? There's the whole language for the objectives. The dual mandate is in here. I'm not going to read it all, but basically, our Congress, and signed by a president, have passed a law directing 12 people to manage the total amount of money and credit of more than 300 million people. Does this make sense? Are these unintelligible principles? Arguably, the Federal Reserve Act could be ruled unconstitutional under a 1928 Supreme Court case. I'm sorry, this element of the Federal Reserve Act. Let's skip ahead. Here's a good quote from Paul Douglas on ethical standards in the federal government. All too often, those who are supposedly being regulated actually regulate their nominal regulators. Independent regulatory agencies aren't that independent if they're captured by the powers that be. Bottom line, we should consider revising or eliminating Section 2A of the Federal Reserve Act. We should eliminate the Fed regulatory and supervisory roles as long as we choose to have a Fed. We can make that case. And finally, perhaps we should consider eliminating the Fed as well as the financial safety net more broadly for our financial system. We have erected a system of privatize the gain, socialize the losses schemes for the powers that be, in my opinion. And I'm coming up with a book in a few weeks, I think, looking at broader issues on this score with a colleague who's a former Air Force lieutenant colonel, 82-year-old guy. Avoid fiscal and economic disaster. Thank you.
Okay, thank you, Bill. Thanks. Okay. All right. Claire, I'll toss it over to you.
Thank you very much, and thank you very much for the invite to be a moderator here. It's a pleasure to be here today and hear such interesting presentations from the five of you. One thing which I think Bill touched on a little bit, which I'd like to bring up now, is just something which, as someone who's covered central banks for almost 2 decades, what I think makes the Fed, or one of the things that makes the Fed unusual, is this system of regional Federal Reserve banks. I think there's broader questions here, but one that I see at the moment as someone who reports on the Fed is that the Board of Governors, where there seems there's a more kind of like direct oversight relationship with Congress, if you just count one of those members, Michael Barr, all 6 of them, the other 6 seem to be broadly supportive to varying degrees of cutting interest rates again at the December meeting, largely on the grounds that they see risks to the US labor market. The pressure to not do so and act on the basis of inflation, which at 3% is still well in excess of the magic 2% figure, is coming more from the regional Fed presidents. What would your thoughts be on that, and how does the Fed and indeed Congress really deal with a situation where it's the Fed president's interpretation of the mandate that's maybe causing decisions to be made that you don't entirely agree with? If we maybe start with Bill and then move across, then that would be great.
Sure. First, I guess one of the ways to start thinking about this is that I don't know what the right interest rate is, and I'm afraid a lot of people don't, and some people pretend they do. Having said that, what you're identifying is a tension that does exist, and that's this regional reserve bank system and the Board of Governors. And the theory suggests that the regional reserve banks are an important component of Federal Reserve independence. And it can work that way if it's done well. I just got to bring up one story I can't resist. In Chicago now, we've had the former chair of the Finance Committee of the City of Chicago recently came home from jail. And we've also had a Speaker of the House of the Illinois Senate, Mike Madigan, go to jail. And we have another person, former CEO of ComEd, has been convicted in this corruption investigation in Illinois and Chicago. She wasn't just the CEO of ComEd. She was the chair of the board of directors of the Federal Reserve Bank of Chicago. At the end of the day, independence can and should be exercised with ethics and integrity, either at the Board of Governors or at the Reserve Bank level, but reserve banks are not a necessary condition for independence and good monetary policy. Thanks for listening.
Yeah.
I think just speak into it and it should work.
Oh, it's on. Okay.
Yeah.
The original idea was that the discount rates would be appropriate for each district, and that's why they set it up that way. Obviously, that won't work. We have a national economy. It's the dollar. We've all got the dollar. So that is not going to work. There probably is some advantage of having district banks. You can take your students on field trips and so on because they're more close by. You can get to know your own central bank president in Kansas City. We knew ours very well, nice guy. But yeah, it doesn't make a whole lot of sense for national monetary policy.
But I mean, do you feel as though they're providing, I mean, in terms of quite a lot of you either kind of implied, or I think you might have said, Randy, just about the risk of groupthink. I mean, they seem at the moment, even if you disagree with the argument, to be providing a little bit of a check on groupthink. I mean, do they play a role there, or?
Yeah, probably some, but also I think the regulatory capture might be a little bit easier to get your local president on board. So pros and cons, yeah.
Capture is an issue both at the reserve banks and at the Board of Governors.
I'll weigh in on that, but I want to say a few things about some comments that were made previously.
Absolutely, please.
First of all, there is nothing about monetarism in the language of the Humphrey-Hawkins Act. at the time, monetarism had a certain academic fashion and a certain political base. And it was necessary to achieve an alliance with the monetarists, including those on the staff of the banking committee, in order to get the Humphrey Hawkins language passed. And so that became part of the reporting framework at the House Banking Committee, which we then altered and has altered over the time. At that time, one could ask the Federal Reserve about its monetary targets. You couldn't ask them about their interest rates. And now, of course, they talk openly about whether they're going to raise or lower the interest rate. That wasn't true in the 1970s. So things have evolved, and the monetary aggregates have become a sideshow. But there's nothing in the law that places them in anything like an important position. I would take some exception to the notion that there's such a thing as a creature of the president, unless you're talking about the East Wing ballroom. The Federal Reserve is a creature of Congress. That is a term of art, and it's an important term of art that specifies who has the right to change the mandate. The mandate itself is a multiple mandate, and I'm Section 2A of the Federal Reserve Act and the preamble of the Humphrey Hawkins Act use slightly different language. But the point and the effectiveness of this was at a time when central banks were being put under immense pressure to focus strictly on the inflation rate, which is what Bernanke brought in his early years. This provided the Federal Reserve with insulation against that pressure, insulation which is not enjoyed by the European Central Bank, which has an inflation target as its sole objective. What's the advantage? The advantage is that when the Federal Reserve wants to do something in response to conditions in the economy, it doesn't have to lie about it. It's not violating the language of its charter. It's true the language is vague. It was intentionally vague. The language gives the Federal Reserve a lot of discretion. Congress is there then to provide guidance and, if necessary, direction in how to use that discretion. But that was the debate at the time. On the regional banks, I highly recommend the work of Robert Hockett at Cornell on their original function, which was as a development banking institution. That was the umbrella under which the Reconstruction Finance Corporation operated from the Hoover through into the Eisenhower administrations, is basically a parallel financial system for the entire United States that was operated out of the regional banks. The regional banks' presidents have no proper role on the Open Market Committee. Their appointment is in violation of the Appointments Clause of the U.S. Constitution. We tried to litigate that in the 1970s. The original case was Royce versus Ballas. Ballas was the president of the San Francisco Fed. There was never an argument that they had a proper vote, that they were constitutionally legitimate officers of the United States, because they weren't confirmed by the Senate. But the issue turned on standing. And after a whole series of elaborate legal maneuvers, the Supreme Court denied cert, and the challenge died. But that's, you could have a regional Federal Reserve banks acting in a developmental and regulatory capacity without necessarily having them in this absurd voting rotation that exists, which gives Chicago a vote every 2 years, along with that other great center, Cleveland, while Dallas, in my home state of Texas, only gets one every 3 years. This is just appalling. Well, New York gets it every year. I mean, what is this anyway? It's an anachronism that could easily be and should be dispensed with. We used to call the 9 banks that got the vote only every 3 years the lesser breeds without the law. That was Henry Royce's phrase for them.
Quite harsh, but
Yeah. So I guess both with the reserve banks and with other issues that come up, I think at a moment like this, one has to be somewhat careful. Like the Fed is in no way a perfect institution, right? And one can criticize it's an artifact of history. The Federal Reserve Act has been amended a number of times since its inception, and there were rough compromises that were made. I think the reserve banks today, they have a very special feature of that you have the presidents and the staff that are out in across the country. Like, they're not just in Washington, D.C. They're not just like tied into the political process. And right now, we have a moment, we've talked about, my goodness, the history of the dual mandate. I mean, we have a moment where the mandate's in conflict, right? Whether you think 2% is just a made up number, inflation's been higher than people were used to before the pandemic, right? And that has been a real concern. And at the same time, job growth has really slowed down. Like, there are some signs that are causing worry. And so I think, whether it's like right now kind of it's more at the board or it's at the reserve banks, I mean, we're seeing exactly like kind of the best case of this system. You've put together, a committee, they're real, and they're digging in, looking through the data, like trying to figure out, assessing the risks. And so, I mean, this is really, it's a tough decision. This is this is like the most complicated setup for the Fed doing monetary policy. What I worry, again, when we talk about the reserve banks and they might not have full legal like exactly, all these details, which are perfectly fine. And something like Congress, thinking big about like how the institution at its best, is that I do worry that you have an administration coming in that already has been very critical of, well, the Fed's already political, so we can make it political. The reserve banks have been, talking about, Black Lives Matter, or they've been talking about climate change, and so we can just shut them down. So I think it's just difficult for those of us who have lots of ideas about how the Fed could be better and its history of, mistakes, and the institution can be improved. You also don't want to end up being handmaiden to the, disassembling of the system. Because if Congress wants to change it, Congress should change it. I'm very concerned that we're going to see an administration, through its proxies that it's able to put on the board, make radical changes that are not in the spirit of kind of improving the system as a whole. So I think next year, watch very carefully with the reserve banks. One of the concerns with the threat to independence had been the reserve bank presidents every 5 years come up for renewal, their positions. And that has to be voted on by the board in D.C. And I think there was real concern when it looked like Lisa Cook's removal was happening very quickly that, the administration might actually have had, the ability to block some of the Reserve Bank presidents when they come due in early next year. It looks like that's probably not the case, but, I don't think this is the first threat that the reserve banks face. So it is this kind of question of like, what would be the optimal setup for the reserve banks? And also, like, I do think they really add something. They bring in voices from across the country to the debate.
And to speak to your point, Randall, about the over-reliance on inflation expectations, which I think is a condition not just unique to the US central banker, but central bankers and central banking theory kind of like worldwide. I think the kind of like the regional Fed network and the product of that, the Beige Book, or one of the products of that, the Beige Book, I think that did give us a lot of insight into the supply chain frictions and what they led to in terms of actual inflation and the reality of inflation compared with maybe the theoretical models. So I see a strength there, I guess. I mean, maybe Pavlina, if you'd like to come in as well.
I just want to chime in with one kind of maybe more technical detail. Part of the Federal Reserve Act is to allow the Fed to furnish elastic currency. And I think we should introduce this into the discussion. And this is a very particular monetary design. It was for the purposes of giving it capacity to address financial crises, to be able to maintain the payment system that checks clear at parity. And so, the Fed has exclusive powers. It is self-financing. Has exclusive powers to issue reserves. And so from a technical, this may be more of an academic point, from a technical standpoint, the Fed has the capacity to issue at will its liabilities and to furnish them to the economy as needed. And I think what we're trying to do here is ask the question, what is that as needed? With great power comes great responsibility. And if it is to provide billions of dollars of interest payments to asset holders or the banking system, then I think we should ask the question whether the economic implications of that policy, that has become the new policy toolkit. And it is not the fact that it issues currency that's the problem, but it is the purpose for which it does. And so, the interest rate policy apart from the question whether 2% is the right target, what is the actual effect on payment of interest on reserves? And, I mean, we have a highly unequal economy. Providing interest income in the billions of dollars, you know, you could argue is a regressive policy. We don't have that conversation on the impact on credit conditions versus the interest income that is going into the economy.
Regarding the value of the reserve banks and the beige book, for instance, I'm sorry for...
No, please go ahead and then we'll bring in Jamie.
Okay, thank you. My first job after graduating in Chicago was I wrote the beige book for the Chicago Fed for about 5 years. And one of the stories from that experience was the 1990-91 recession. You had payroll employment dovetailing and then going sideways according to the official statistics, but that was the payroll survey. On the flip side, the survey of households, no one was watching it, but employment was rising significantly. But people believed it was a jobless recession. Some of our best contacts, we had big temporary help companies based in the Midwest, Kelly Services and Manpower. Talking to them, they were seeing a recovery. And so we at least had a chance to try to interject. There is a value to having people out there in the field in a world where it's hard to measure this stuff.
Especially at the moment, right, when you've had the congressional shutdown and there's a dearth of a paucity of federal
We talked about
statistics.
flying while blind. Well, you know, what data do we have and when do we know it?
Bring in Jamie now.
Yeah,
Thank
I
you.
want to specify that neither the Federal Reserve nor the federal government as a whole were responsible for the rise of inflation in 2021, 2022, and the Federal Reserve had absolutely no leverage over the inflation rate once it started to rise. There were several factors involved here. One of them was the fact that the oil price, as you may recall, collapsed to zero in the pandemic. And when it recovered to $70, which is just where it had been a year or two before, that was recorded as a substantial shock to the consumer price index. Then there were the supply chain disruptions, which were also pandemic related. The inflation rate, in short, is driven primarily by international commodity and supply chain factors, and partly by the way in which housing prices, which are highly leveraged by rental markets over in a society where many people are homeowners, and of course my imputed rent that I paid to myself went up dramatically. I'm sure that made me feel good, except that I wasn't noticing anything. Plays into the inflation rate, which then is reported, by the way, on a year-over-year basis, unlike the unemployment rate, which is reported on a monthly basis, which gives certain op-ed writers who shall not be named an extra 11 months to pound the Federal Reserve to raise interest rates, which is what they did. The Fed started raising rates in March of 2022, if I recall correctly, and the price increases peaked in June or July, when the rates had only risen by 75 basis points, long before they peaked rising rates. And the price increases came down after that. So there's simply no connection here between what the Fed did. It did not raise the unemployment rate. It did not slow the growth rate. It did not have the leverage over the economy that Paul Volcker had in 1981, 1982. Didn't produce a crushing recession. So what was it doing? The answer is it was playing a game, and then trying to make up the notion that expectations, which were driven by the Fed's own necromancy, were responsible for the come down in the inflation rate. Well, okay. I'm afraid to say that I feel a certain measure of guilt and responsibility for this, because if we had not been giving the Fed this platform for 50 years to project its views to the public, they wouldn't have come to believe that they're the little Dutch boy with their finger in the dike, without ever looking for 40 years over the top of it to see if there was any water in the lake, which there wasn't.
Could I just add something on
Please.
inflation? Because all right, it's true that for a fairly long period of time, inflation was 2% or below. And so a 3% rate looks pretty high compared to what it had been for quite a while. Jamie and I are old enough to remember when inflation was much higher than 2%. And we lived with it. I think that inflation is taking a hit, taking all the blame because the economy is rotten for huge parts of the U.S. nation. That workers have had absolutely stagnant wages since 1974. This is the problem. And so I think that we're misreading what the problem is. The problem is not that inflation is 3% rather than 2%. The problem is that anyone who has driven across this country can see most of the country is in very bad shape. And so inflation is taking all the blame for this. And this is in part, I think, because of both monetary and fiscal policy have been misguided for a very long time.
No, I think that's a really excellent point, and I think, to bring it back to the building we're in and the people in this room, it seems as though, one of the stories of inflation's fallen quite a lot from what it was in 2022, but this sense of there being an affordability crisis has not. I mean, we've seen it in elections over the past few weeks. We saw it for the Biden administration. Even if the figures that us economists might be looking at for GDP growth or whatever, unemployment look pretty low for a long time. I mean, even if we're seeing that, there's still this sense in which there's an affordability crisis, and it's hurting people who are elected officials as well as the general public. So with that in mind, I guess, before we turn to the audience for a Q&A, it'd be good to know that what would your advice be for members of Congress or their staff now, given that the nature of the US economic issue for real people is one of affordability? How does Congress address that in the way that it kind of manages the relationship with the Fed and holds the Fed to account? So maybe we start with Bill and then go across.
I'm going to, I guess, react because Jamie provided one bullet point that was Congress should do its job. And I think that's the starting point. Congress, as long as it has the power to coin money and regulate the value thereof, needs to stop outsourcing its responsibility and doing a better job. We disagree, I think, in some of the people on the panel. But for that basic point, Congress has been, it's almost like the Fed is valuable because it's an outside entity that they can blame when things go wrong. And Congress should take responsibility for what we have.
What does that responsibility look like in practice? It goes back to 2%, and I'm sure lots, but in the UK, if inflation falls either above or below 2% by a certain margin, the head of the Bank of England has to write a letter to the Chancellor.
I thought you were saying.
But I mean, I don't know if that's done much to help or hinder. But when you say Congress needs to do its job, does it need to have these more mechanisms such as that, or is it more kind of members of Congress speaking out on the Fed? How does that look in practice, I guess is my question.
I think we need to fundamentally revisit Section 2A of the Federal Reserve Act. It's so ambiguous. We need to do a fundamental rewrite on what we are directing the Fed to do.
So specificity, basically.
But before we had stable prices as a mandate, we did have another mandate on the government as a whole. That was from the Employment Act of 1946, and it was purchasing power. Let's think about how that is different but similar to stable prices and maybe purchase. Anyway, Congress needs to deliberate and do a better job of doing its constitutional authority, not outsourcing it to the Federal Reserve.
Yeah, two very specific responses to that, if I might. First, I'd call attention to the fact that in the interwar period, Congress created the Temporary National Economic Committee, which provided a foundation for much of our later understanding of how the economy works. That entire structure, which includes the national income accounts, is now out of date. And an open-minded re-examination of all of that would be very much in order. The world was created in the 20th century. We're now well past that period, and we live in a different structure. So that's the first point. The second one is that in order to do that, Congress would need to take two steps. First of all, it would need to have the appropriate internal structure. The banking committees are no longer such a structure. They're much too big. They exist largely for fundraising purposes, and they do not effectively have the capacity to exercise the power that they have under the statute. And secondly, the economics profession is now hopelessly out of date and stuck in a set of paradigms which need to be thoroughly re-examined from some independent perspective. That's very difficult because there really, apart from present company, isn't such a perspective available. It's a very thin base on which to operate. That's the situation, and I think that's part of the dilemma of thinking about how you would actually go about reconstructing the policy process.
Well, you stated it better than I did. Purchasing power is what we should focus on, rather than let's try to stop some prices that drive the CPI from going up. Let's increase purchasing power by raising wages. So we should be directing policy to improve wages, benefits, living standards, making sure that congressional authorized spending is raising our living standards. Spending $1 trillion a year on interest by the government is not raising our living standards. A lot of it's going abroad, it's going to financial institutions, and it's going to rich people. Okay, that's doing nothing to raise purchasing power of Americans. So we focused on that. Good jobs, good pay, good benefits. I think people could live with 3% inflation, which is, it's not only a magic target, it's a magic measure of this aggregate thing we call the price level, okay, which nobody buys. Nobody buys that price level.
I share your enthusiasm for thinking about purchasing power. It's also worth considering, I think, that purchasing power could allow for a slowly falling price level over time, too. This is debatable, I'm not going to say I have the right answer, but that's part of the problem. People will debate over what these directives are from Congress. If they were to adopt purchasing power, well, guess what? There's different ways to do it. It's going to be a political process.
Well, I just want to object to that because we all have debts, and that's the problem with declining prices. We lived through a high inflation period. I had a lot of student debt, and thank goodness we had some inflation and rising wages that allowed me to repay my student loans without a burden. On the other hand, in the Great Depression, we had falling prices. And what did that do? It bankrupted everybody. So falling prices is not a good idea in a monetary economy.
I mean, that's what some of the economists will say about the logic of the 2%, right, though. I mean, this is the kind of argument that you don't want to end up with another depression, so you have it a bit above 0 and then 2%.
I think by the way I look at things, 3% is better than 2.
Okay.
It gives a little bit more favor to the debtors.
What's
wrong with that?
I think 3% is rising prices. That's not what Congress said. Congress said stable prices.
Okay.
So I guess I would just add on the affordability issue. So I do think that the interest rates that the Fed sets matter. Like I do think the Fed is having an effect on the economy. Protecting Fed independence, right? So if we had ultra low interest rates next year, as the president wants, I think we would end up with inflation. Maybe not right away, but it would come. So I think protecting the Fed is, that's like kind of taking one inflation, things worse off the table. That's not enough, right? As was mentioned before, a lot of the inflation that we've seen in recent past and over our history are these kind of supply-driven inflation. Like the way the Fed deals with inflation is it takes customers away, right? That's their tool. They're depressing demand, and that's the way that the tool that they have can fight inflation. Part of how inflation came down is instead of fewer customers, we got more workers in this last episode with more immigration. So it's just one example. And it's like Congress has the ability to address supply-driven inflation. Be completely wary of easy fixes, right? Like there aren't easy fixes, but Congress has the ability to do much more targeted, much more like look particularly at housing, look particularly at in the food supply or whatever those cases are. And it's like you want the Fed kind of as a bulwark of doing kind of overall price level, but that's not sufficient. So I think one mistake, and maybe this is, kind of this idea that the Fed can go it alone on inflation, that's a mistake. Right, the Fed can't go it alone. Or if you let them go it alone, you will regret that decision because it will cause a lot of hardship. Or it just won't, move the needle on the inflation, right? If they're not willing to put the economy in a tailspin. So I think that's just kind of this. I think the affordability piece is a real thing. I mean, people have, because it's not just inflation's been higher, it adds up over time, and then also there are very specific sectors like housing that create challenges. And so while the Fed is important, the Fed is not enough. Like protecting the Fed is not enough to move forward on affordability. And unfortunately, I think there are a lot of easy fixes. Often it's easier to kind of move demand around than to build supply. There's a lot of easy fixes that could end up very badly. So just to be aware of that, as you all know. I think that's not.
Lisa Cook had a good line recently. She said people are they're being told that inflation is coming down, but they don't feel like it. They want prices down below where they were before the pandemic. I think that's a realistic feeling that's out there. People like stable prices.
But if their wages went up, then the price of cereal is not going to matter that much. But I think, what we've been doing here at this panel is really asking questions about the canon and the standard way in which we're looking at Federal Reserve policy. If Congress were to, assert its oversight power, I think it would be useful to really start, to ask some of these foundational questions. If the Fed itself has stated, and I'm quoting Janet Yellen here, that the inflation model of the Fed might be fundamentally misspecified. If there are, dissenting voices within the Fed that the NIRU is not, doesn't hold up empirically, then we really should all be questioning then, why are we basing our policies on this framework? Are there other ways? I agree that the Fed, as I stated, is a systemically important institution. I agree that interest rates have an important role. I think where maybe we disagree here slightly is that the impact on interest rate on investment and credit conditions is rather weak. At least our research at the Levy Institute shows that it's quite weak. So the capacity of fine-tuning the macroeconomy is then weak. But there are, of course, those impacts on debtors and creditors that we're just discussing. And so the impact of interest rates on balance sheets, I think that I would love to see a discussion like that of what is happening to asset holders, what is happening to debtors. When Chairman Powell was interviewed last year, and he said we're a creature of statute, and we will report on the mandate that Congress gave us, he explicitly stated that he will not incorporate budgetary costs as the reporting. The Fed reporting to Congress. But interest rates have a direct impact on the budget, and the interest rate payments that we just discussed, $1 trillion a year, is a significant chunk. And, we can't escape the fact that the budget deficit is weaponized. And when there is a big chunk that is eaten up by interest payments, then other programs on the chopping block. So there are political implications from Federal Reserve policy, and I think we should just be upfront about them, and we should examine them as technocrats. And I think Congress needs to be part of that conversation as well.
So could I just see yes, please. If you wouldn't mind just standing up and letting us know your name and affiliation, that'd be brilliant.
Yes. Hello, everybody. My name is Raphael. I am from Montreal, Canada. As a question, could it be a good idea to go back to what happened in the United States and Canada 80 years ago? I think there used to be some offices of prices. Could it be a good thing to start to regulate prices in order to help the economy?
Well,
Good question. Thank you.
you're posing the question to at least the right person, because as you probably know, my father, who was originally Canadian, in 1941 found himself as the deputy administrator for prices of the Office of Price Administration, therefore with effective control over every price set in the United States from late 1941 to May of 1943. And this was, in fact, a measure which transformed the economic management of the country compared to the First World War, when inflation basically risked getting out of control, and led to the post-war period in which American households were flush with the government bonds that they had been willing to buy in the wartime period because of the expectation, confidence, that they would retain their value under a reasonably stable price regime. Can you do this? The answer is you can, but can you do this with the government we have or the ideology we have and the economics profession that we have? The answer is no, you probably can't. So this is I think you interpret a good deal of the intellectual history since the late 40s, early 50s as being set out precisely to discredit the direct intervention of the government in price mechanisms. And why is that? Because the people who set prices do not want to have popular power or governmental power looking over their shoulders. I'm not saying that that power would not be abused, but I am saying that that power is regularly abused by the people who have it. And they're happy with that situation.
Would it be a good thing to regulate prices?
Well, some prices can be regulated. Rents can be regulated. They are regulated. Some prices are directly intervened, commodity prices, by the government. What happened in 2021 was that the price shock in the energy markets was broken, not by the Federal Reserve, but by the White House, by the Biden White House, which began to sell oil from the Strategic Petroleum Reserve for precisely this purpose. And that was an effective strategy which stabilized that price. You can argue that maybe they shouldn't have depleted the reserve and that they might have had a higher purpose for it later. That's a strategic decision. But they did intervene to bring that price down, and it did have the effect of bringing it down. The answer to that, does the government get involved in prices? Oh, yes, there's another price that the government sets. That's an administered price. I almost forgot. It's called the interest rate. We have this textbook model, the interest rate is set according to supply and demand. No, it's not. It's set by the Federal Open Market Committee and it meets every 6 weeks and decides what it is, and it goes exactly where they want it to go. So, of course we have political prices being set all the time.
You share in the blue shirt. Thank you. You can do. Just if you can let us know your name and your affiliation.
I'm Sanford Friedman. I am a retired accountant who's studying heterodox economics in a school in Australia. One other person here. So my question is on interest in general. One is the government's paying interest obviously on the Treasury securities, which we talked about, but what the Federal Reserve is paying on, and you talked about, Randy, you mentioned the corridor system. There's other central banks that have a floor, which is the overnight interest that they pay to the member banks. So how would you fix that? Because isn't that a way they are now using to control the interest rate by setting a floor, discount windows and the ceiling? So is the fact that they're paying all this money just to banks the issue? Or would you suggest another way for them to just set a rate and not try and keep it between these two quarters? Maybe you can explain it, because I just learned about it.
Oh, well, just very quickly, the reason they had to, reason they need to use 3 interest rates is because they decided they would leave massive excess reserves in the banking system. Normally, to keep the rate from going to 0, they would have to take the reserves out. So if you're going to leave reserves in the banking system, you're going to have to do something to prevent the rate from going to 0, unless you want it to be 0. All right. I think quantitative easing was completely misguided. We said it's not going to work. It did not work. What it did was it left reserves in the system. Now the Fed is committed to paying interest on reserves. The Fed also bought a lot of trashy stuff, which is why most likely its equity position is far, far deeper than what anyone wants to admit, and we may never know how bad
But if
it
they're
is.
gonna, I'm
So
sorry.
there's a lot of things came with that. So what should we do? What Minsky always advocated was don't supply reserves in the open market. Supply them only at the discount window. You only need one interest rate. You get to look at the bank's books. You say, we don't like what you've been doing. We will lend reserves to you now, but don't come back, right? You fix your business model so that you don't have to come to us to get reserves. You can borrow from other banks. I think that made sense when he was writing back then, and it makes sense now. And then it eliminates all of that stuff. We go to the discount rate, and which the central bank, from the very beginning, had some power to decide what that should be. Okay, so a different kind of system. I would still constrain that
Thank you.
because it will be the base rate, even if we get rid of the other ones.
Yeah, I mean, I think as you say, it's a kind of kind of a child of the QE era, really, where if you want to, I mean, in terms of doing what they wanted to do, of setting this lower bound, it's a very effective mechanism. Where they seem to be having more trouble at the moment, actually, is at the upper bound and getting people to use the standard repo facility. But I think there is a lot of fear, maybe some of it unjustified, about just the degree to which they want to control short-term interest rates, and I think it's part of that. Did you have a question? Or? Sorry. You please, and then was there anyone else? We maybe take two at a time, just for. So if we take your question and then David, you at the back, both at the same time, then that would be great, and the panelists can address them in turn.
I'm Trip Powers. I'm also in the Torrance program, and your conversation about the regional governors sort of sparked kind of a revelation I had, and combined with just the economics profession being essentially out of date. So I remember hearing, going up to the election, that there are a lot of people who believed that unemployment was at an all-time high when it was at pretty historically low numbers. And I want to just attribute this to social media and to the blogospheres and people just getting bad information. And then I came across the Levy Institute, which publishes different unemployment statistics. And they claim that there's 25% of the American workforce is functionally unemployed. Either unemployed, long-term unemployed, part-time employment looking for full-time work, or minimum wage workers who are looking for better jobs. And they say that's 1 in 4 workers, and I'm going, okay, so maybe the actual people who are telling us that they think unemployment is really high are right, and the way we're measuring things is wrong. And we have maybe an outdated economics profession, and it seems like our policymakers have lost touch with what's actually happening. Our statistics don't represent reality for people anymore. Their lived experience seems to be really different. What do we have to do so that the Fed, Congress, presidency, et cetera, can actually get good information to better inform policy? Like, what statistics need to really be reworked, looked at, and debated right here?
Great question. And David, would you like to? I don't know if you'd like to speak to that as well.
Sure. So my name's David Hiles. I used to work for one of the statistical agencies. And so my question is, what kind of economic measures do you think would be more helpful going forward? Now, of course, you have to have serious people who are interested in looking at them and applying them to the reality that we live in. But I noticed that the national statistics, the unemployment rate, the monthly jobs number, great. What does it mean for what's happening in Kansas City and Cleveland and San Francisco? They're very different things, right? What is the rent for a one-bedroom apartment in Dallas versus San Francisco? So, and how should those be things, inputs into this idea of purchasing price, right? So purchasing price parity in Cleveland versus San Francisco, is that something we want to measure so we can manage it? And what would you want to see? What do you think would be useful?
So two great and interrelated questions. Maybe start with Pavlina and Claudia, and then.
Well, I think we need to be looking at expanded definitions of unemployment for sure. I mean, the BLS does have its expanded definitions. I would say it's still even the, U6 is still narrower. I like to look at the National Jobs for All Coalition that's adding, part-time employment for involuntary reasons. There are other ways of looking at the problem. Unemployment is a very particular thing. It is looking for work, not being able to find it, or looking for a particular kind of work, not able to find it according to the expanded definition. What you're talking about is the fact that we just have massive precarity. We have something close to 45 to 50% of working families earning under $25 an hour. This is our economy. It does not function. It cannot possibly function with $25. You cannot pay rent almost anywhere. So I think that it is looking at the right places. I mean, I use the living wage calculator all the time that is issued by MIT. It's not official government statistics, but I think that, trying to bring those into the policy conversations, if we're all concerned about paychecks and well-being, I think that there is data. We can always use more data, but I just want to say that there are ways of looking at how far the paychecks go, and we do need to have a national conversation about what constitutes a good job, what constitutes a good support system, the kind of conversation that we had in the 30s about what should the state provide in terms of the social wage, the basic support to make sure that businesses thrive, families thrive. We have not had this kind of national conversation for a very long time.
I'll take a stab at it without at the risk of getting out over my skis. But I would suggest that when the unemployment rate was the dominant policy variable in the 30s to the 70s, the concept here was largely of a household with a single earner that was supporting a family. That broke apart in the 1980s. It broke apart with the industrialization, the collapse of the manufacturing sector, and basically the entire structure of the economy was rearranged so that today predominant American household, which may still have a middle-class income, gets that income by having multiple jobs and multiple earners. So that when, for example, in the pandemic, people lost their jobs, many of them did not lose their entire household income, and many of them lost jobs which were only marginally contributing to their household welfare because there were commuting expenses and childcare expenses, all kinds of other expenses. And the pandemic relief gave considerable cushion against that. So what happened in the post-pandemic period with the interest rate increasing was put pressure. The benefits were cut and the interest rate went up. And households began to feel the pressure to go back to jobs that they did not want to have, that they gave them very marginal benefits. And that they resented being forced to go back to a world that could have been avoided by rising wages and giving better working conditions. But if you raise wages to bring people back into the labor market, then you have to raise them for everybody who's already working. And that's a very expensive proposition, which will affect the whole distribution between wages and profits. Whereas if you simply pressure the person who's holding out and not in the labor force, and therefore not raising the unemployment rate, to come back into the labor force, then you are putting pressure precisely on where it's weak, where people are vulnerable. And guess what? They're going to vote for the other party the next time around. They're going to resent this because they understand what's happening to them. So again, that's a speculation from observation rather than dealing with the actual body of statistics, but I think it's reasonably well founded in what happened in the last 5 years.
Yeah, and I would say the unemployment rate can be a very useful metric of how things are changing in the labor market. But that, there is a real benefit from having these fuller measures of employment. And I mean, to the Fed's credit, they don't define maximum employment as some unemployment rate. Like, it kind of gets operationalized that way, but it's much broader in kind of concept. And one of the things that I found in discussions where people are like, well, in a recession, it's only the unemployed that get hurt, and that's like a really small fraction of the population. But if it's inflation, everybody gets hit by inflation. And it's like, well, actually, no, when the unemployment rate is high, most workers are suffering, right? Like, they may not have lost their job, but they're not getting their wage increases, they're not having new career opportunities. So the unemployment rate is a very good kind of like, it has a purpose, and I don't think it's so much measurement, but it doesn't capture that fullness. And frankly, the way the Fed's mandate is written, it has that fullness. So, and I think there is some understanding of that at the Fed. But in terms of communicating to be better, in terms of what more we could have in statistics, just like you ought to be grilling any appointee or nominee to the Fed, anything to statistical agencies at this point ought to be getting a real careful look, because the statistical agencies are also under threat, if nothing else, from just the fact that their budgets have been cut dramatically, their staff are down, and they are attacked by politics. Like, their whole legitimacy, I think, is questioned. But what has over time been a real area that the statistical agencies have pushed out on, and certainly should have the resources to do more of, are exactly these kind of getting beyond the aggregate statistics. Whether it's looking at geography or it's looking at income and wealth. There's been a lot of discussion about the K-shaped economy and the top 10% of households by income, or 50% of spending. We don't know that. That's an estimate, it's a very thoughtful one. Mark Zamek does a nice job with the data, but it's not. It would be really good to have kind of measures, timely measures, for exactly those kind of what's happening in the economy, who's really getting hit. Like, the Fed has a national mandate. It's inflation overall, maximum employment overall, but the tools the Fed has with interest rates, you're talking about the balance sheets, the monetary policy does not work equally through all households in the economy, right? And we should be seeing that. That doesn't mean that it would necessarily change the policy, but we ought to understand what are the effects of the policies, who's getting hurt, who's being helped. And having government statistics that really get at the distributions and get at it quickly enough that it can be in these conversations of what are we doing with interest rate? Not like 2 or 3 years later we get some sense. So there's absolutely a need for that, to have more of it. But that's the agencies have really run into funding issues.
Okay. Well, I don't think it's going to do much good at all to tweak the measures of inflation or unemployment for the purposes of policymaking. I think we can tweak them for the purposes of economists to do research studies and write papers for publication. I don't think that it has much import at all for policymaking. I think policymaking should be fundamentally reformed. Instead of, oh, well, the unemployment rate has ticked down below what we think is the natural rate, so we're going to raise interest rates this month by 25 basis points. And then next month we'll see, oh, we'll raise them again, 25 basis. Come on. This is not the way to fight potential problems of inflation or reverse of unemployment. You tackle it a different way. How do you tackle unemployment? Job guarantee? Done. Should we still measure the unemployment rate? Okay. But you don't need to know that for policymaking. You've got a job guarantee. It picks up everybody who doesn't have a job. Problem solved. One problem. Okay, it doesn't necessarily solve the problem of wages. Okay, so we've got to pay a decent wage there, and still we could have distributional problems of inequality. So tackle those. The CPI measure, again, the Fed should not be in charge of fighting inflation. It doesn't have any tool that will allow it to do that. Let's fight it a different way. What our major problems are: oil, housing, and food. Let's tackle those. How do we tackle housing? We build housing, public housing, okay? Housing for all, okay? Medical care, Medicare for all. Okay? That's what you do. You don't need the measures for that.
Last word to Bill.
It's hard to be against better economic statistics. I'm a big fan of looking at the issues. When you look under the hood on how they measure this stuff, things get very interesting. And as long as we do have a central planner for the most important price of all, we better do a good job of trying to measure this stuff, and maybe more, not less, in terms of resources today. However, I'm going to step back, and here's a voice that hasn't been heard from. Those are the folks that think statistics are enabling central planners. It's a tool of central planning, and those are people that are out there too. Aggregate statistics are useful for the people that think they want to be able to manage the whole pie for all of us. Some people don't think that's a wise route. So there's pros and cons.
Well, thank you very much. So I think I'm going to bring the discussion to a close now and just say thank you so much to all of our panelists, and also thank you to the audience, some really excellent questions there.